Cool. All right. So I will be sharing about so kind of just hashing about the high level of Bitcoin. But first, can everyone see this the presentation? Okay, cool. All right. So the slide link is in the Zoom chat. Follow along if you have any questions. Kind of cool stuff to look at as well. Let me open the chat. Okay, cool. So just kind of a table of contents. I'll just talk about like what I myself have worked on, kind of what I've done. Also, just it provides good context, and then I'll talk about blockchain in general. And then beyond from that, we'll talk about Bitcoin, which was the progenitor of all this activity. It was the first thing, the first blockchain, the first widely adopted digital currency system. Then we'll get kind of a little bit into mining, and then public-private keys, just to give you context on how this stuff all works and how it all fits together. All right, and then also, so blockchain UCLA is a student club. This is actually, we were founded late 2017. So this is actually, we finished 4 years of operations. This is actually the 5th year of the club in operation. It's something I started my freshman year as one of the co-founders. Most of the other co-founders have graduated at this point. But the club still goes on. We have a board, including several members of this in this chat. So just to name a few members of the board, there's Jack, Kiro, Zeke, and David. So those everyone from the board is all in the Discord, can also help you guys with anything. So if you guys have any questions or just want to talk to someone, feel free to reach out to anyone there. They can coordinate with the rest of the team, and we're always open to partnerships of just helping anyone else on campus with blockchain activities. We also historically in the past have done a lot of kind of just like visits with companies. So back in like the 2018 era, there was a bunch of new blockchain startups kind of taking off, and in the local LA area, it was a really great chance for us to get people who were working on blockchain startups to come speak at UCLA, while also getting UCLA students who were interested in this sort of technology the chance to hear from people working directly in the industry. So it was a really cool thing. We've done that for several years now. Had a really cool list of speakers the past several years. We've had Tim Draper come and speak. We've had events with Joseph Lubin, who's the co-founder of Ethereum and runs Consensus. We've also had Masari for an event last quarter. So yeah, like lots of cool stuff. If you guys are interested in any of this the technology behind it, coding it, trading, financial activities behind it, the implications of it on a broader societal level, definitely a really cool place to kind of share your thoughts and just get into a community that kind of cares about blockchain on campus. Also, I would like to mention CS188. So when the club first started, we would have these weekly lecture series where we would come out and teach people. It would be we usually would have these like on a Wednesday or Thursday night. We would come to similar thing we're doing now, but in person. We would have just weekly lecture series on like what is Bitcoin, what is blockchain, how do these things work, and it was a really good experience for us teaching people how this stuff worked, but also for people coming out and learning, getting exposure to this stuff. This eventually turned into a official class at UCLA within the engineering school. So it was first taught in winter 2019 as an accredited upper div engineering class, and it was continued in spring 2020 and spring 2021. So for the past 2 years as well. Listed under Professor Gaffney, who is a professor in the computer science department. He's also the chair. The class covers everything relevant to blockchain. That'll get you on the technical side of things. So it starts off with distributed systems, cryptography, goes into Bitcoin and Ethereum, and then it covers a bit of decentralized finance and whatever also new topics in the space. The class also generally has a good selection of guest speakers. 188s are generally pretty flexible in terms of both their grading and also like their course structure, since they're considered a special topics class. So if you guys are interested, these courses are all tentative. We can give you guys more information as this stuff comes out, but historically it's something that the club has done, and I know the school is also just interested in offering this stuff again. So we'll keep you guys posted. There's also a Discord channel in our Discord for this exact purpose. And as for stuff I work on personally, outside of, also I was one of the TAs for this class. So I help teach it and host it. And as for what I work on currently right now is it's Frax. So I'm one of the co-founders of Frax. We are an algorithmic stablecoin. Started implementation and launched late 2020. So we've been live for over a year now. We just hit a 1 year live last month, and we've been working very hard, pretty much around the clock for this whole time on getting Frax widely adopted as a stablecoin. So we're actually the first fractional algorithmic stablecoin, which is a bit of a twist on the traditional models. Normally in this industry, when it comes to like stablecoins, right, tokens that are pegged to $1, they're either usually collateralized through a trust model, as in like a custodial, like a custodian manages the collateral behind it through like a bank account, right? So for Tether and USDC, which are the two, most used custodial stablecoins, they're essentially a bank, right? Because they issue the tokens on chain, which represent a dollar. So you're able to, store your value in dollar denominated tokens instead of just, whatever assets. So they give you these tokens, they hold the collateral in different bank accounts and other financial instruments. And they allow you to redeem it for fiat, right? So for like regular cash through their off ramps, right? Tether uses BitMEX, I believe, Bitfinex, I believe, and then USDC is run by Circle, which is a US company, which is also partnered with Coinbase. So if you'd like to offboard your USDC stablecoins, you can just make a Coinbase account and offboard through that. And that's kind of the trust model, right? But this also has some drawbacks since being completely custodial, they're tied into the traditional financial system. And there's certain things that they kind of have to abide by in order to operate, seeing as they are more of an extension of what currently goes on, but in a cryptocurrency form. And the other kind of model for cryptocurrency stablecoins is the collateralization method, which is that the collateral exists on chain within smart contracts. So this first was popularized by the stablecoin DAI, which was the project that runs DAI is called MakerDAO. And so MakerDAO is this pretty complex on-chain smart contract-based system that exists entirely or almost entirely on the blockchain, where everything is managed through a series of smart contracts. You can think of it as like a fully transparent, a commercial bank. And the idea is that in order to get these stable coins, you would offer loans in the form of your Ethereum. So you can loan out your Ethereum and generate and take out a loan against it in this form of stablecoin called DAI. And it's the third largest stablecoin on Ethereum. So it's quite big, market cap of around 10 billion. And then what we did with Frax is we pioneered the idea of being fractionally algorithmic, which is that we're actually a 2-token model. We have Frax, which is the stablecoin, and we have Frax shares, which is a seniorish token. A seniorish token represents future money printing in the system. The basic idea is that you would use some collateral, in this case USDC, but also some of the seniorish token, in this case Frax shares, to mint one new Frax. And then there's a collateral ratio, which will allow the system to kind of adjust on how much FXS and how much like hard collateral is needed to mint one Frax. The system's doing quite well these days. We're actually the 50th largest cryptocurrency in general, in just the stablecoin, with a market cap of 2.6 billion. So we're growing every day. This past couple of months have been a lot of the supply growth. So something that we're still very hyper focused on. So then that's kind of some background on like stuff we've done here as a club and also just personally. And I kind of want to just give an intro on like what we want to talk about as like blockchain as a concept. So as most of you guys probably have somewhat of an exposure to blockchain, kind of just want to talk about this in terms of in the formal setting. So I kind of just want to introduce this concept. The actual blockchain itself it's a system for maintaining a distributed transaction ledger. So these blockchains, right, were actually the term was derived from Bitcoin, right? Bitcoin, the system was actually first just released, and then people kind of started making all these like formalizations around Bitcoin and the various variants Bitcoin, like the different coins that came out after it, because Bitcoin was the first one to do such a system. Now we'll actually get to the reason why Bitcoin worked compared to previous predecessors. There was attempts throughout the 90s and early 2000s for digital currency, since the internet by that time was decently widespread and we had computers. But there's a couple of reasons why Bitcoin itself came together and was able to be the first accessible, widely adopted digital currency. But in general, these blockchains are just systems for maintaining these distributed transaction ledgers. The first part, distributed, is distributed in the sense of computing. So there's multiple nodes running these things, and they all kind of keep each other in check, making sure everyone's acting in agreement, so that the network can move forward together. This is why people say this stuff is decentralized, is because you're not relying on a single entity for the source of truth. If you have a bank account and you go to your bank and they keep their own copy of their records, and they say like, hey, we don't recognize your deposit. We just don't, it's not on our records. You're out of luck, right? You have to take it up on yourself with whatever actions you can take. Whereas in the blockchain systems, each node that is running a copy of the blockchain is a participant, is a witness, holds the data, holds the whole history of these transactions, and it can actually verify with you the whole entire state of all these transactions. So that's kind of the distributed portion of it, and also the ledger portion. It just keeps track of everything. I think this, yeah. So that's just another graphic. So we'll give you kind of an intro into just Bitcoin. So that's the idea of a blockchain, right? Which is really just an abstraction of these cryptocurrency systems. To give you the high level on Bitcoin, so Bitcoin is the original. It was released. It was first theorized through some internet forums. It was bitcointalk.org, I believe, was kind of where the founder Satoshi kind of posted his ideas and started working on the concept. And it combined a lot of different elements of computing that existed at the time, but really weren't used together. The main idea of Bitcoin, right, is that it's digital cash, but the actual implementation of, or basically how it's built, is what gives it its magic, because it's the kind of culmination of several different ideas that allow it to act as digital cash. And the same idea is that, in the modern day, the paper cash we use today is actually just a bunch of things, a bunch of processes that are fit together, right? Like the act of actually printing the money, the act of record keeping, the act of culturally acknowledging, how cash works and what cash is valued at. Similarly, in Bitcoin, this is like a kind of a digital version of that. You have cryptography, which keeps things verifiable and honest. You have the distributed systems portion of it, which allows anyone to join the network. And you have the actual economic incentives, which keeps the entire system running. And it gives you sort of trust assumptions or guarantees that people essentially will act a certain way according to the incentives given to them. So on a quick history of Bitcoin, you have in 2008, the actual original Bitcoin white paper being released. Satoshi Nakamoto is the founder. Of course, he's if you haven't heard by now, he's anonymous. It's been theorized that he's several different people. It's also been theorized that he is a collective of people. It's not widely known to the public who he actually is. So he still remains to this day in the public eye, an anonymous person. In 2009, the actual Bitcoin blockchain, the Genesis block was mined. So it was the first block that kind of gave rise to all this. And then in kind of some quick history, just 2010, people started like in the early days, it was a very low key niche kind of thing. Only kind of heard about and talked about in some like circles within like the internet and cryptography. But then 2010, the first purchase was made with 10,000 Bitcoins in exchange for 2 pizzas. So this actually was a story that was pretty popular a few years ago, about how when Bitcoin first hit like $10,000, like $19,000. It talked about like how like it people, like someone actually bought 2 pizzas with a bunch of Bitcoin, which at the time was worth less than a penny. So we've come a long way. and probably will go a long way further with where we're at now. And then ever since then, there's been a bunch of other stuff that's happened to it. But this is kind of the original 0 to 1 story. Everything else, all these other companies, all these other topics, all these different ideas and systems inspired by Bitcoin have been released since then, although it still remains strong to this day. So when you talk about Bitcoin, you also have to talk about what money is. So I think one of the kind of trickiest things to learn about Bitcoin is that it actually highlights the assumptions that you make in everyday life when it comes to money, because normally people don't question where their money is coming from or how their money works. They just accept it as money, right? Which is pretty fair because for most of our history, right, like we either lived in a barter economy, or some sort of like gold-backed hard asset reserve system. But money is pretty important because it defines a lot of what we can do in this society, and the three main purposes here of it that applied both to just cash we use and also Bitcoin is the fact that it's used as a store of value, so you can store your economic value in it, right, your economic energy into this form, right, of money. It's also a medium of exchange. So you can transact with it, you can give people it and pay each other. One actually cool idea that for me I thought was really cool is the more I thought about this, the more I realized, like, in absence of a monetary system, capital still exists. It just exists in other forms, right? So back when we had a barter economy, your capital wasn't money. Your capital was the food and like the shiny gems and like the land, or maybe not the land if you go back far enough, but capital still exists because we're humans, right? Like humans are very good at abstraction. We're able to create systems where we can understand and operate at many different levels. And as a result, we can create these very highly complex transactions, all in the matter of our day-to-day lives. And then one other kind of addendum to that is that social capital is also one thing that's kind of been used in human history, although we don't mention that much. It's just like it's pretty apparent, right? Like you have your financial capital, but you also have social capital. If your friend like buys you a pizza and it's like, oh, like it's, even if it's like not like directly materialized, it's still some sort of social capital that you'll buy him a pizza or whatever if the time comes, and so on and so forth. So kind of cool idea to think about capital in the way of value, not just kind of cash. Yeah. And then the last thing is that money is also a unit of account, or provides the utility of being a unit of account. So the unit of account one is actually probably the hardest to grasp your head around, because it's not something that we need to think about, especially because our economy is so developed and like complex, and also kind of everywhere. But the second part is that the U.S. dollar, like we're all tuning into it, UCLA here, like it's in the U.S. The U.S. dollar has been the world reserve currency for like probably like over like almost 100 years now. Being the world reserve currency, you're granted a lot of privileges because of the system we live in today, which is the fiat system, one where the money supply can be created or contracted or expand at will by the Federal Reserve or the central bank in other countries. And then as a result, with the US dollar being the unit of account that people denominate their trade in and kind of conduct their economic activity in, the kind of measuring stick is really important, right? Both from like a geopolitical perspective, getting people to use your measuring stick, but also just from a kind of conceptual level, right? Like which measuring stick do you use? If this was a bartering economy, you would have to be using plenty of different measuring sticks, right? Like 2 like apples for 1 orange, et cetera, et cetera. I'm sure like if you guys have been, in barter economies before, like the dining halls, you could trade swipes, right? You can say like, oh, I'll give you this for like 2 swipes. Online video games as well, there's different like units of accounts, different currencies. And one thing we kind of never like realize is that like prices as well. So, and we'll probably get to this at a different point, but the idea of a price is just a ratio between 2 things. How many units of A per 4 units of B. it's just that in today's like economic, like capitalistic system, everything is so able to be measured in dollars that we're able to start even measuring time in dollars. We're able to measure kind of these other abstractions that were never really meant to be measured in such ways. At least that never happened before, and in terms of dollars, right? So no longer is this 1 unit of A for 1 unit of B. It's just like anything in terms of dollars. So it's the unit of account is very powerful in terms of like a psychological kind of cultural effect, like network effect it has on people. And also, one last thing about this on the slide. So 90% of the money in the US is digital. So you guys have probably heard of M0, M1, M2, kind of the different ways the monetary supply in the US is accounted for, managed by the central bank and the commercial banks, and the different Federal Reserve banks across the US. But yeah, so a lot of this money supply is actually just sitting between banks in like interbank lending and loaning. With the current fractional reserve system we have going on, it's pretty much a system where borrowing is encouraged to earn money off interest, but also to allow people to open businesses, so on and so forth. But the capital is always flying around in this kind of banking system as a result of how we've how we set the system up. And then just to give you guys some perspective on like what our current financial infrastructure looks like, right? Our financial pipelines. A good example is to go through what happens when you swipe your credit card. So when you swipe your credit card, to you, it's a very abstracted process. You don't have to worry about anything. All you know is that you have a credit card, you have a PIN number, and you can just swipe it anywhere. And the merchant will take, it'll just put into some machine and it gets taken care of. But on the back end, there's actually a lot of different moving pieces that happens with this. You have yourself, right, who swipes the card with the merchant. You have the card network, which is the one, which are the people who are actually operating the rails of the system, right? So the rails would be, moving money from A to B, so from your bank to another bank. These card networks kind of operate as the financial plumbing between these banks. Since the banks themselves are just interested in doing the accounting for who has what, there needs to be an intermediary that involves doing all the processing for you. And so the two biggest in the world are Visa and MasterCard. These kind of take care of all this technology behind the scenes. So you can almost think of these guys as like a centralized payment. I mean, they are a centralized payment service, but in the context of like a decentralized currency, not only is the unit of account different because it's a decentralized currency, but the medium of exchange is different. And also the store of values is different because there's a different monetary supply with these digital currencies. But yeah, that's kind of just some insight onto like how complex our current systems are and how actually Bitcoin, although complex in and of itself, is actually not a whole new layer. It's really just a different way of approaching things than what we currently use today. So to kind of give you guys the intro on like, the actual operations of Bitcoin. So, the general idea is that two people would just want to transact money digitally from person A to person B. This is the white paper slide. And the idea here is that it's digital, like Bitcoin is itself a digital currency, but a better explanation of it, or kind of a de-abstracted way to think about it, is actually just, it's an open source computer program and computer network that's used to regulate the generation of these units of currency and verify the transfer of funds while operating in this peer-to-peer structure. So just to kind of decipher that, or to approach this again, what does it mean to be regulating the generation of units of currency? It's really just managing the monetary supply. We in the US don't ever actually have to think of, we don't like normal, non-central bank participants in the US don't actually ever have to think about managing the supply of the US dollar, right? Like that's usually taken care of in a room of bankers, which have a bunch of economic forecasts, and they sit behind these closed doors. They have a meeting, once every few weeks. They talk about like, hey, well, the economy is looking like this. We project, some of these things. And the original purpose of these central banks was to make sure people had jobs. So it was a kind of a jobs idea, but also just manage inflation. Since price levels are actually something that are quite important, right, in an economy. Before you had central banks, right, you would just have, you know, gold. You would just have economies where they would just be trading gold or whatever, or spices. And the idea here is that the supply, like money as a technology, right, you can view it as some sort of like as a societal instrument, right? There's a certain supply of a certain money in a society at any one point in time, and depending on how that society is doing in terms of productivity, can determine how people are acting, how much people would like to spend, right? The base kind of driver of all this stuff we're doing these days is just productivity, right? Goods and services that provide value to people, that people would like to, you know, they want, they desire, so they can, you know, transact for these things. This productivity, you know, leads to, you know, these goods and services that need to be like exchanged. And this is where you have the money come in. But in these kind of central managed monetary supply systems, this management is done in sort of a top-down fashion, where the rules are not necessarily strict. They're kind of a play it by ear thing. And you kind of have this ability to print money or you know, remove money from circulation as the central bank, as the kind of, you know, the controller of the system, in order to manage things like financial crises, other things such as, you know, just like financing, you know, large national expenditures. You know, a lot of times this happened in the case of like wars. So if there's like a war going on, wars are obviously very expensive with everything that has to be produced. You also have, you know, just like other domestic issues that would require a lot of, you know, money, right, or just value or productivity being directed towards it. So the management of the monetary supply of the monetary supply is in some way a way to kind of control this. You know, the management of the supply of money is something that's, you know, a very core thing to our day-to-day lives. You know, it determines how we can go out and buy a house, how much how much the house price will be, how much the interest rate on borrowing money for the house is in terms of like the mortgage and all these sort of different things, right? These are basically all determined because we're using one single currency that's being centrally managed, which is not the case, which is a bit different for Bitcoin, right? Because in Bitcoin, the supply mechanism is actually enforced, and it's predetermined, right? So whereas in, you know, the current system, you have a bunch of people who meet in like Switzerland once every few years. The Bitcoin monetary system, which is, you know, over $1 trillion in market cap, is actually run by kind of a system of different parties. One group of people being miners, people who actually put the electricity into, you know, verifying all these transactions. You have people who are spending the Bitcoin. Then you have people who are actually developing the software itself to be enforcing the network rules and kind of adjusting things as they deem fit for the progress of the currency of the network. The second part of this is kind of describing the verifying the transfer of funds. So Bitcoin uses really cool cryptography that is pretty widespread these days. It's called elliptic curve cryptography. I'm not going to get into the details because it'll probably be 30 minutes worth of math, but these cryptographic kind of algorithms that started to like get really big, and they were discovered in the 70s and 80s. It got pretty big because they allow people to just, you know, they allow people to hide information extremely easily that cannot be cracked without extreme effort, and sometimes cannot be cracked with any means that we know of. So these encryption methods allow people to not only encrypt information, but actually sign information, right? So if you have you know, these encryption methods, right, and modern ones, right, because there's historical encryption methods that would, you know, use like Roman ciphers, right? Like back in the day, if, you know, in the Roman Empire, if they had like messages they needed to pass back and forth, they wouldn't, you know, write it in like raw Greek or Latin. Sometimes they would, you know, put a cipher on it, maybe just like, you know, add one position to the letter of each word or whatever, you know, to protect it if it, you know, like fell into like enemy hands. But in this case, right, like you actually have computers which are extremely good at doing a lot of computations in a very short amount of time. So as a result, you have these very complex circuit systems that have been built over this past century that allow us to kind of create these uncrackable systems with how much complexity we put into them, right? Another way of thinking about this is like, imagine the world's best like Rubik's Cube scrambler, right? Like, back then, if you only had a 3x3 Rubik's Cube, you could kind of solve it by hand. But nowadays, our computers are essentially like gargantuan, like extremely efficient Rubik's Cube scramblers that'll scramble like 1,000 by 1,000 Rubik's Cube, and it's like impossible for a normal human to kind of unscramble it by hand. You would have to use extremely sophisticated mathematical techniques to even try to attempt to break some of these things. And then as a result, because these tools are in the hands or accessible to everyday people, you have the ability to kind of share information and keep it secret as you wish. But you also have not only the ability to encrypt things, but the ability to sign things digitally, right? And so we'll get to this at the kind of the end of the presentation today, but the ability to sign something digitally is actually extremely important, because you can actually show that whoever signed this system, right, was the holder of the keys, right? And so the ability to kind of sign things digitally allows for provenance, right? Proof of ownership. I'm sure you guys have heard of NFTs. Part of the whole value of NFTs is you can prove you can own it, right? But like, how do you prove you own it? You can sign statements digitally, proving that you have the ownership of these NFTs. So this is kind of where the cryptography comes into Bitcoin and all these other systems. Is that you have this ability to verify and also just sign transactions, which allows the money to be spent, knowing securely that this is the person who sent it, and this is the person who received it. This is also probably a good time to take questions. So if you guys want to like kind of interrupt and like say something, I'm happy to talk about them, like anything you have questions on. All right, cool. So I guess I'll just continue. Can you give us a short example of a signature? Yeah, so a digital signature would be there's different algorithms. There's different algorithms that implement this sort of stuff. But a basic one that Bitcoin uses is that it uses properties of algebra to to scramble a string of information, string of bits, ones and zeros, such that if you had the other piece of correlated information, the kind of matching key that the person signed the transaction with, right? Because it's a bit string of ones and zeros that gets operated on like a mathematical function that does something to the bit string, right? And what happens is it spits out a different string, right? And then this new string is now the signed piece of information. And then in order to kind of unencrypt it, you would take the person who signed it and then take the other part, the public portion of what they have, what they used to sign with, right? And then you would apply the kind of de-encryption operator onto this newly encrypted bit string to recover the original message. This is a field of this is a basic explanation of asymmetric cryptography. But you can think of it as basically you have a key pair, a private and a public one. You sign using the private one, and then anyone can decode it by just looking up your public key and just reversing the operation because they have information of your public key. So the Bitcoin network itself is a collection of computers running the Bitcoin software. The Bitcoin software itself is hosted on bitcoin.org. So the Bitcoin software itself, it's written in C++ actually. But what it does is it just basically handles all the processing of these transactions. So anyone can actually just download the software and start submitting transactions of their own if they have Bitcoin, or they can start mining it. Whatever they want to do, they're kind of fit to be participants in the network. There is some distinction here on the different roles in the network. People who are miners, people who are kind of just people like actors who are just transacting, and then also other actors who are not in mining, but they're also just keeping track of the blockchain. So kind of get into that. But the basic idea here is that the actors on the network are referred to as nodes. So they're just running this instances of the software, and they communicate with one another. You can kind of think of this analogously as like instances of like AWS, right? So like even though AWS is centralized, whereas like because you can spin up an AWS server yourself, but you're having Amazon do it for you. Whereas in this case, you would actually be downloading and running the instance of the software on your actual computer, and you'd be connecting to other computers. So this allows anyone to be running the software themselves without having to rely on another party. The actual development and distribution of the software is completely open source and free. So it's kind of an equally accessible environment with no walls per se. And the idea here is that these nodes would, these software nodes would be connected to the internet and propagating new transactions with one another in the form of new blocks, right? So these new transactions are first broadcasted. They kind of sit there pending, and they kind of wait until they're picked up into a block by a miner. The miner is the one who successfully mines a new block and includes the next batch of transactions into the blockchain, and then tells their friends, tells the peers. Then everyone else, through economic incentives, is incentivized to mine the next block in the chain. And then this is sort of a kind of its own consensus mechanism, which is kind of its own kind of abstraction. But essentially, right, you have the miners who are all competing to be the next person to add a block to the blockchain. And so they do this through a mining puzzle. This is also referred to as proof of work. We'll get into proof of work as well, like just very briefly. So you can kind of see this, just the it just like the transactions themselves just propagate across the network to each of the users who are peered to each other. The peering happens in a kind of lookup process where there's also just like peering, like network peering algorithms that have taken away this complexity for, like it just relies on already existing like peering algorithms that have been developed in like theoretical computer science. But you can think of the problem setup as like, hey, if you have a set of users and each user has a list of, say like 3 or 4 or like 1 to n users it's peered to, and someone else joins your network, how do you get them the list of names of people who else to peer with? The more peers someone has, the stronger they are, since they're more tapped into the network, and the more reliable they are to pick up any potential inconsistencies within this network and be able to confidently pick a side of a dispute to support. So in this case, it would just be the new blocks that hold it would be the new block that holds the new transactions that's being propagated across the network. So that was kind of the distributed like systems portion of the Bitcoin network, and now we'll talk about hashing. So I briefly mentioned about like the idea of signing things and verifying transactions. This is a little bit different. Hash functions are also mathematical operators. They operate on ones and zeros, so they operate on bit strings, but they do so in a way that's it acts a little bit differently. So in a hash function, right, a cryptographic hash function, it takes a string, right, like ones and zeros or whatever, and it spits out a kind of like a fingerprint, right? It's what it does is you can think of it as like scrambling eggs, right? The idea here is that these hash functions are deterministic. So if you give it the same input, it'll give you the same output every single time, and you can actually create a map from the inputs to the outputs in order to protect the information of the inputs, right? So if you don't want to tell someone that you know what the password is, right, to like the Wi-Fi router, right, but you want to prove that you have it, right, what you can do is you can just hash the Wi-Fi password and give them the hash, right? And you tell them like, hey, I'm going to use like this hash function, right, which is available, it's free, it's open sourced, it's like available online. If you really want to verify that I have the Wi-Fi password, and you have it yourself, you would have to just, you can just verify by checking my hash, right? Now this setup would actually, of course, it would require the verifier to also have the Wi-Fi password, not just the prover. But you know, if you wanted to prove to someone you had this information and they also had it, but they didn't want it like necessarily broadcasted out loud, you can just share the outputs of the hash functions, which would allow someone to just to check, because you can just run the hash function on your own, you know, by yourself. This is kind of analogous to like a radio decoder in like World War II, just like running the algorithm, like just writing down, like decoding something in their notebook, right? Like it's the person who is receiving it or sending it who does it locally and then just broadcasts it across the network. That kind of keeps this input information secure, right? And the idea is that these hash outputs are computationally infeasible to reverse. So what happens is that if you're given just raw hash functions, it's no better than just guessing what the input could have been, because there's no correlations, there's no patterns to what the output is from what the input is, right? It's completely random, right? One bit of the output, whether it's a 1 or 0, has a 50-50 chance of meaning the input is also a 1 or 0. So these are kind of just this kind of dives into like information theory that was like pioneered by like Claude Shannon. He talks about diffusion in hash functions, but the idea in information theory here is that you don't actually need to you don't want any correlation, any hints, any thing that's able to be reverse engineered to allow people to figure out what the inputs are from a hash function, right? Because if a hash function was reversible, it would be a very poor hash function. These hash functions are supposed to be basically just completely random. Like you wouldn't even be able to guess what the output of is of an input unless you actually just ran it through the hash function. It's basically just a deterministic randomizing function that'll get you to the hash outputs. And then this is kind of the verifiability of the whole thing. And this is actually pretty important in the blockchain setting, because this is actually the property that allows all these blocks to be chained together, which we'll talk about. So we just talked about hashing. We'll talk about right now, like what is the blockchain? It's there's a question. Who has access to the hash function? Yeah, good question. So hash functions are also like they're online. They're like completely open source. So like if you want to go, you can just yourself, right? And it's like hello, right? And you know this is the actual hash, the output of the hash function. So you can see, right, like the hash output obviously changes as the input changes. But if I just write the string hello, the first 4 characters are 2CF2. And so, if someone wants to like check that I have like knowledge of a secret piece of information, and that piece of information is the word hello, I can give them the hash output and they can check like, oh yeah, like this guy has the right, piece of information because the hash function checks out. So these things are all open source. They're actually managed by the National Institute of Standards of Technology, I believe is the name, the NIST. The NIST is actually just a federally funded organized agency that holds these competitions every couple of years or so between mathematical researchers to try to find, to award people for figuring out the best algorithms, because these things are actually all built on trust. Like they're built on mathematical assumptions, because what they're doing is they're basically figuring out like a really like it's kind of like just a good way to basically scramble some eggs, right? Like you're finding ways to scramble these informations by just doing like, oh, like we'll just divide by 2 here, we'll like multiply by 5 here, a little bit simplified, but you kind of get the idea, right? It's just like a series of steps that's written out, and these steps, if they're not done carefully enough, they are crackable, right? So it's actually kind of a cat and mouse game where it's kind of like an arms race, right? Where it's like these the existing algorithms, because they're all open sourced, and you can actually just read like how SHA-256 actually works. If you I mean, I actually have a slide about this stuff, but it's basically just like a bunch of like XOR operations. I'll just show you guys if you guys are curious. Yeah, you can. This is what SHA-256 is. It's just each one of these represents 32 bits, right? So it's a 256-bit. It's actually it's an unlimited input into a 256-bit output. These block operators are actually XORs. So you take 32 bits, and if it's longer than 256 bits, you actually just start wrapping it around itself. And then it actually describes these other block operators that do these things. But like sigma 1 here is a specific like set of like XOR operations with bit string. So this is the actual like mathematical function. It's just saying like, okay, like the 32 bits of E ORs with 32 bits of F, which is just XORed with the complementary of E, like ORed with G bitwise. And then that's what the CH block does, right? So as you can tell, this gets quite logic based very quickly, but it's all, you could do it by hand if you wanted to, because it's all open sourced. And then, David brings up a really good point. David's also probably much better at describing hash functions than I am. He has a really good mathematical intuition. So yeah, it's ETH also uses Kitchak 256, which is kind of a variant of SHA. So yeah, there's basically like tons of varieties. You can kind of see right here. There's like, you can pick like a bunch of these different standards. They have like different output like strings. Like, so this one has like, that, and then this one has like a little bit bigger of an output string, and then this one has a little bit bigger of an output string. These are used, the reason there's different like algorithms is because they have different levels of like, they have different methods. And also in kind of encryption settings, right? Like you might not necessarily be encrypting on just your laptop. You might have like a small like device, such as like a key card that you use for your bank account that you need to encrypt with as well, right? And say these key cards need to be mass produced, so you can only put a very simple cheap chip onto them, right? Well, if you have a very simple cheap chip, it can't do very complex operations. You would actually have to make sure it uses a relatively simple hashing function in order to be able to be, produced without being too expensive, right? So these are all a bunch of these trade-offs that come at the implementation level, which is basically, it's like an arsenal of weapons. Whatever your operation is, you wouldn't bring like a rocket launcher to an FBI raid unless you're like in Tijuana, but you get the point. Yeah. So, and then Drew asked a question: hard as an impossible, or possible but super time intensive? So this is actually a great question, because they're actually the same thing. It's so hard that because it would take so long mathematically to guess, right, that it would just be essentially impossible. The universe would run out of energy before, yeah. And then, yeah, cool. So then we're gonna go back to blockchains. So yeah, you have these list of blocks, and the way they're chained together is each block has a list of transactions that are that represent the actual signatures of people sending money from A to B. So this is like, again, another kind of very novel, very cool idea that we won't get into in this presentation, but it's the idea of the actual UTXO model that Bitcoin uses. So if you guys are interested and want to read up on your own time, you can read about UTXOs. So UTXO Bitcoin is, I think Wikipedia has a decent, yeah, it's this, I actually have a presentation on it. I can link to anyone who's interested as well, but that actually just goes through like the whole idea of like how like these transaction models work, like a bunch of stuff, but you don't have to worry about it. But you can basically just think of this as the list of transactions that are cryptographically signed, and they're put into a block, right? So the list of transactions, like the transactions themselves are just data, and they have like a certain size, right? So the idea here is that you have a fixed block size that can just fit however many transactions they can fit inside of it. The transactions themselves are actually put into a structure called a Merkle tree, which allows for very fast verifiability that a transaction was actually included into a block. We'll talk about Merkle trees quickly in a second as well. But yeah, you have this chain of blocks, and the reason why these things are all chained together is because the block itself, right, all the data in it is hashed. Basically you just like, all right, I'm going to hash all the data from this block into like one small like 256 bit output, right? And then I'll take that piece of information, that like block hash, and I'll put it into the next block, right? The next block's data. And then that way it serves as sort of a pointer to, it serves as a pointer to where the previous, like where it fits into the blockchain, right? Because say if you're at block N, right, you have, the block data and you have a block hash because the hash of all the data in the block. Then you go to block N+1. Block N+1 can tell you where it's coming from because it'll just, in the previous block header field, it'll just list where, the previous block's header, and it'll forms this sort of like one-way linked list of like where all these, or all of the whole history of the blockchain, right? So then in block N+1, right, it takes in the hash of the previous block and then into its own hash, right? And when it creates its own block hash, so that block N+2 now has data coming from block N+1, but block N+1 has data that comes from block N, right? Because it includes the block hash of the previous block and its own block hash. As a result, if you change one transaction in block N, it'll change the block hash of block N, which will actually falsify the rest of the blocks. So this is what gives Bitcoin and all these other blockchains the kind of immutable history property, is that you can have the ability to link all these transactions together through each block's hash being included into the next block. All right. In sort of okay, Brian had a question. If I'm coming from a language like Java, does a block have properties that would differentiate from an object? Or can I conceptualize a block as an immutable object that just happens to have a hash, data, etc.? Yeah, you can think of it in this case in an object-oriented language. A block would just be like an instant, like a certain class, right? And it's in one instantiation, the class like properties would, it would hold a hash, it would hold the block hash, it would hold, data, which is, in Bitcoin's case, I believe it's 10 megabytes. It might be 1 megabyte. I always get this wrong. Yeah, 1 megabyte, right? So in Bitcoin, the data field, right, of this block is 1 megabyte block hash, and then you have like a certain, you basically have a bunch of metadata properties, like which version of the blockchain this is on. This is just used for like software updates of like, updates to the blockchain, so on and so forth. But yeah, you can think of it as just like instantiation, like a class of in your normal like kind of Java perspective. How can someone join the network without having to download the entire chain from the start? Well, if they truly want to verify all the transactions, they would actually have to download all the transactions from the start. But if they don't want to rely on someone else, they can do that, which is what most people do. When most people send Bitcoin, they just rely on another node to verify all the transactions and to process them and to like run, and broadcast their own transactions. Or you can run something that's called a light node, which isn't too common, but it's theoretically possible, and allows you to kind of skip some of the harder verification procedures by just storing less data. What do you mean verify transaction? Okay, yeah. So if you're running a node on the blockchain, right, and what you have to do is first you have to sync with everyone else. So you basically connect to the peers, download the entire state of the blockchain up until this point in time, which basically means downloading and replaying every single transaction that's ever happened in the history of the blockchain until the current point. And then you start listening for new transactions that come in. And when the new transactions come in, you yourself as a node software operator, the software will just verify the cryptographic signatures check up of the actual incoming blocks, so that you are basically saying that you agree that this incoming block you received is actually valid according to the mathematical rules and the cryptographic rules, saying like, okay, we're basically, the code will just make sure all this stuff checks out. Then if it does, you will kind of broadcast this accepted block to your peers. So that's what it means to verify transactions. Okay, yeah. The kind of other, like the third leg of the stool here is consensus. It's the glue holding the system together. The idea here is that the public blockchains, they use this peer-to-peer network that anyone can join. When someone joins the network, they start to copy. Like what I just said, they download a copy of the whole blockchain from the very beginning. And then when a new block is created, the creator shares the block with everyone else in the network. And the creator in this case would just be the miner who successfully finds a input to the mining function that satisfies the difficulty rules. That's a whole nother idea, but the idea is that the Bitcoin network is also like self-regulating. It targets a 10-minute block time. So it just targets a new block produced every 10 minutes, which is kind of the invariant, right? It's like a constant of the network. As a result, it has to kind of adjust this dynamically, right? So this is kind of a really cool piece of the algorithm built in, because the number of miners is always changing, right? Because of economic conditions. Sometimes like a country will just, or even political reasons, like, if a country just bans Bitcoin mining, the number of miners will obviously go down. How does the network keep up with this, right? How does it basically make sure there's still enough blocks coming out? It will reduce the difficulty of finding a new block to allow the remaining miners to find a block at the same rate that was originally targeted. This is called block difficulty, and it's one of the property of the system. Yeah, so yeah, this is kind of the whole consensus mechanism. The whole mining puzzle is just its own abstraction, but it's basically just a guess and check puzzle to figure out like a random number that satisfies the properties of the network. Cool. And then the kind of other part of consensus here is that in Bitcoin, you have something called the longest chain rule. The longest chain rule is the one that's considered canonical and thus the true Bitcoin. So because it's a distributed system and there's no central authority, how do you come to agreement on what is, what if there's a split, what if there's a dispute, what's going on? The idea here is that the longest chain is the canonical one, right? Canonical being the one that's like, like on, that's the one that's accepted. Your transactions on non-longest chains are not longest chains are not deemed to be valid by the protocol specification. Thus, miners always want to be mining on the longest chain. So this is kind of just like a rule, like a social consensus rule we all just agree on, right? It's like that's written into the software. Like basically, this is a rule, one of the kind of rules of how the protocol operates. The idea here is that the reason why miners always want to be mining on the longest chain is because they actually get paid for finding a block, right? So the block that they find includes a transaction, a special type of transaction called the Coinbase. And the Coinbase is actually the transaction where the Bitcoin is minted out of thin air to be given to the miner who found the block, right? To be given to the address of the miner who found the block. And then as a result, the miner wants to be mining on the most recent valid chain, because if they discover a block on an old chain, that one doesn't conform to network consensus rules. And as a result, all the work they did into finding a valid block gets wasted because that transaction over there doesn't count because it's not on the longest chain. Okay, and then you have, okay, yeah, wallets, private keys, public keys, proof of work. All right, I'll try to get through this quickly since it might be getting long for you guys. Okay, so in the system, you have Bitcoin wallets, which are used, which are programs that are just used to send and receive Bitcoin, and monitor account balances. So you have email programs like Outlook and Gmail that are used to manage your email. Bitcoin wallets are just used to manage your Bitcoins. They manage your private keys and public keys. So they create these keys, which is called like key derivation. It uses a bit of entropy or randomness, which is basically just gives you like a set of random words or a set of random bit string, a set of randomness that'll allow you to pick a unique key pair within the enormously large set of possible key pairs. Yeah. Public keys are the, kind of the addresses. They're akin to a public pseudonym that you use to receive funds. So you can kind of think of this as like an email address, but without your without actually having your whole name on it, right? Like basically a random, string of letters that corresponds to your kind of public like mailbox address, essentially. And you have private keys. So the private keys are basically just long string of numbers or letters that acts as the password to your wallet. The private key here is under the context of asymmetric encryption, which means there's key pairs. Every public key has a private key and vice versa. Every private key has a public key. That's why they tell people, so they tell you like never share your private keys, because your private key is the one that can access all the funds sent to your public key. It's the key that unlocks the Bitcoins for sending. It signs transactions for you. And other people can verify that this private key was the one that sent transactions coming from the public key, because these keys are paired together. And then the Merkle root structure here is something that is pretty important. This is why you're actually able to have extremely cheap verification for transactions when in terms of data storage, because you have you have all the transactions within a single block. In this case, there's just 8 for just an easy graphic. Each transaction is hashed according to like the publicly known hash function. In Bitcoin's case, it's SHA-256. So you hash all the functions, all the data of the transactions. And then what you do is you start hashing them pairwise so that they start inheriting data from the predecessors, right? And what you end up with pairwise hashing all the way up is that you end up with one singular Merkle root remaining. And the Merkle root is the one that provides verifiability for any other transaction in this set. So what happens is that, say you have transaction 5, right? What someone can do, they can just store the list of hashes, right? And then they can just verify anyone else's transaction. So the really cool property of this is that you don't actually need to store all the potentially very large transaction data. You can just store the small hashes, right? Because the hashes are like fixed size outputs. So if you want to just store like 8 items of like a 32-byte output, you can recreate all the Merkle, you can recreate the whole Merkle tree. And what happens is someone can come to you, give you transaction 5, right, which is a large piece of data, and then you can hash it all the way up alongside all the hashes you currently have to recreate the Merkle root, right, which is the remaining hash, the final hash in this Merkle tree. And you can verify that if the Merkle root checks out to what you already have stored, then this was the transaction that was included in the block at the time of the hashing. Otherwise, if it doesn't match up, then it was not the actual transaction. So this is the verification process explained. Then you have Bitcoin mining, which is the way to do it, create a new block in this context. The inputs here are just the Merkle root of all the transactions in the block, the hash of the previous block, and plus something called a nonce. So the nonce here is the number that is like varied in order to try to beat the difficulty puzzle. But the idea here is that with the whole difficulty and the things we talked about already, this just basically gives people a puzzle to figure out to really just run on their computers and use energy, right? So they consume energy to run this Bitcoin mining puzzle, which will hopefully get them a satisfactory output, which will allow them to be the ones to put the new block onto the blockchain. This is usually, with Bitcoin's case, like these block rewards are very large. The block reward is now like 6.25 Bitcoins. So like, that's like $300,000, I guess $200,000 now, but it's a very large amount of money. As a result, in practice, a lot of this stuff happens in what are called mining pools. So people kind of pool together mining power or just hash power to repeatedly guess and check different nonces to try to output an acceptable function, an acceptable hash, right? And the idea here is that the output of the hash has to have a certain number of leading zeros, which is the difficulty of the mining algorithm. But yeah. Okay, cool. And then there's this is actual kind of performing the SHA-256 algorithm by hand, proof of work. So yeah, kind of what I alluded to earlier, proof of work. Bitcoin mining is an example of proof of work. You prove your work by solving for this valid hash. And the idea here is that the valid hash, right, like a number of leading zeros that's satisfactory, it's no better that there's no better method for finding an acceptable hash output than just guessing and checking. So you just have to guess and check the whole entire time. As a result, you might as well just, like the way to do it is to brute force it and literally just guess and check using your computer. And because of that, it takes a lot of work to solve because they want all the hash power on the network to be only finding a block on average once every 10 minutes. And there's also statistical variation. Sometimes it takes like 40 minutes for the network to find a block. Sometimes you get 2 blocks back to back. But yeah, and Ethereum is moving towards proof of stake, which is its own different consensus mechanism. In this case, you would stake capital, the network's native token instead of energy, right? Because the idea here is that the base unit of input for a hash output, right? You have to input electricity in the form of computational power, right? Like you have to put in, you have to input computational power. Yeah, you have to put input electricity in the form of computational power in order to get these hashes. Okay, yeah. Thanks for coming. That's the end of the presentation. You can also join the Discord. Reach out in the general chat. We're active there. If you want to check out Frax, the link is here. I'm also on Twitter at @JasonHuan_. I'd love to talk about anything with like blockchain and Bitcoin and stuff in general. I usually get a lot of messages, so I can't really respond to stuff right away. So yeah, like if you have any questions, Discord, the Discord is also a kind of great place to reach out, since myself and the rest of the members here on the board, like we're always on this, on this Discord. I'm happy to help out as well. Yeah, thank you, Albert. Yeah, and then I hope that's everyone's questions. I'm just going through now. Also, we have a membership form, so if you guys are on campus, you want to come to these things officially, get added to the email list. Fill out the membership form. You will get, we'll have your contact information directly, so that we can kind of just keep reaching out. But yeah, we usually host things to the Discord. So if you want to keep coming to these sort of things, definitely, pay attention to the Discord, and we'll go from there. Yeah.